One of my best ideas is called closed-end arbitrage. It's a great example of how we're working harder for you to get returns in a difficult market while at the same time reducing risk. We're currently working particularly hard for you in fixed income where yields are so low you need to be creative to get a reasonable rate of return. But before we explain this concept, it's important you understand what NAV, or net asset value, is.
All funds work off NAV. It's the value of all the securities the fund holds divided by the number of units. So if a fund held 4 securities, each worth $1, every unit would have a NAV of $4. If one stock were to fall in price by 25 cents, NAV would now be $3.75. If each security fell in price by 25 cents, NAV would now be $3. So in open-end mutual funds, everyday people are allowed to buy or sell at NAV. So if someone invested $10,000 and NAV was $4, the mutual fund would create 2,500 new units and go out and buy 2,500 shares of each of the companies they already owned.
Closed-end funds are a little different. They don't have the ability to create or destroy units on a daily basis to match investor inflows and outflows. They do one big offering, and then the full offering trades in the stock market. When investors are excited about the fund, it trades above NAV. If they aren't excited about the fund, it can trade below NAV or at a discount. This happens more than you might think. Let's look at how a closed-end fund comes to market. Normally, financial advisors and investment bankers rave about new funds that are coming out. They might indicate to clients that there's nothing else like this product anywhere, so they sell it to clients at $10 per share. But the investment bank takes a 3% commission for taking the company public, and the broker takes an additional 3% commission. So on day one, the client has shares they paid $10 for, with a NAV 6% below this, or at $9.40, because 60 cents of commission has been pulled out.
Shares trade around $10 for a bit, but now without brokers or investment bankers cheering on the stock, because they have already taken their commission, excitement about the fund dissipates, and the fund trades down close to what it's worth, its NAV. Now the fund manager takes the cash of $9.40 and goes out and buys $9.40 of bonds or stocks. As time goes on, especially if the fund isn't performing as well as people hoped, holders want to get out of the fund. Because you can't create or destroy units in a closed-end fund, the only way to get out of the fund is to sell your shares into the market. With lots of sellers and few buyers paying attention to a fund that has already been issued, prices tend to trade below NAV.
This is where I get really interested. Let's say we can find a fund that holds bonds and we can buy it at a 5% discount to NAV. We'll go to the fund's website, view the most recent NAV, and know we're getting it at a 5% discount. In the past, we've even built live models of the portfolio the fund holds to better estimate what the NAV is in real time throughout the day versus waiting until the NAV is posted on the site at the end of the day or week. We now go buy these shares at a 5% discount to NAV.
Once a year, the fund allows us to do what's called an annual redemption. This is where we can return the shares to the fund company for the full NAV. This is a feature many Canadian closed-end funds have to avoid the discount to NAV from becoming too large. When we buy the fund at a 5% discount, we understand we'll have risk and exposure to the underlying asset the fund holds. If the stocks or bonds the fund holds go up by 5%, we made 5% on the underlying holdings, plus 5% by closing the discount to NAV once a year. If the fund drops by 5%, we lose 5% on the underlying asset, but make 5% on closing the discount to NAV. So we're flat for the year when investors in similar assets would have been down. If the fund loses 10%, we make up 5% by closing the discount to NAV. We've cushioned a loss only losing 5%.
We view this as a win-win. We get exposure to an asset class we would have wanted to buy anyways, stocks, bonds, mortgages, etc., but we're going to do 5% better per year than someone buying a similar open-end version of that fund. Often, the large fund companies have very similar open-end and closed-end funds, so it might have been something we would have bought anyways. The magic to the strategy is there are normally 2 redemption periods per year, one in June or July and one near year-end. So we can buy a fund at a 5% discount, redeem it mid-year, and give ourselves a 5% cushion on the market. Then, after we get our money back mid-year, we find a fund with a year-end redemption and redeem it at year-end. So we've closed this 5% discount twice in 1 year, meaning we've created a 10% head start versus most investors.
We have just explained one of our best ideas called closed-end arbitrage. To learn about the basics of other investment strategies, please visit our website or send us your questions.